Hey everyone, it's Brandon Rush. Thank you for joining us for another episode of The Agent Investor. The goal of The Agent Investor is to help our audience make informed decisions in their commercial and multifamily businesses through conversations with professionals and individuals in the space. So today we have a new friend of mine, Andrew of Freedom Management, joining us. I'm going to dive right into it. Andrew, thank you so much for joining us.
Thank you for having me. Excited to be here.
Absolutely. So, Andrew's a new friend of mine, so I'm not going to botch his background and experience and what he currently does. So, I'm going to let him jump to it. So, Andrew, tell us a little bit about yourself and your experience in the commercial and/or multifamily space.
Sure. So, like many of your audiences, I was sold the American dream growing up. I was sold get a good education, get a good job, make six figures, get a nice swanky condo in a city. Like I did all that. I got my master's. I got a nice six-figure job at the Broad Institute. I bought a condo in Boston. Like I did that all through my 20s. And then come around COVID, I really looked at my net worth at that point. And that's when I read Rich Dad Poor Dad. And I was
Mm.
like, and my net worth was $250,000 at that point. It literally, and $200,000 of that was from that one bedroom condo. So it literally took a decade to save up $50,000. And at that point, it was like a light bulb moment. Like maybe there's something to this real estate thing. And that's when I decided to just YOLO. And I like HELOC my one bedroom condo for $200,000. And then I essentially just uprooted my entire life, moved
Mm.
to Massachusetts and started house hacking multis, buying commercial multifamily, eventually running out of my own cash, syndicating, joint venturing. And 4 years later, I built a multifamily portfolio of around 350 doors and a
Nice.
PM company where we self-manage about 250 doors. And I'm thankful to say I left my job back in June. So that's kind of a little quick synopsis of my background.
Excellent, excellent. So it's funny. A lot of us have the same story. 95% of us hit that, got that rich dad, poor dad. I don't know what it is, but it just makes complete sense. And we just kind of get hooked, and then it's like an epiphany for all of us. And then we all go different routes in terms of where we end up. But a lot of us, that's the catalyst for the beginning of something new.
So I think the thing about Rich Dad Poor Dad is it shows us that it's possible. It shows
Mm.
us that there's a route outside of just the 9 to 5 track to escaping the grind, right? The rat race. So
Absolutely.
it literally like grabs a cord just from like the ether on like the right mindset you need to be a successful entrepreneur.
Absolutely. One key thing you also mentioned, in addition to Rich Dad Poor Dad, is net worth. Kind of in the same place I was when through my 20s. It's like you grind, you hustle, and then you hit your 30s, and then you finally start thinking about you start learning about financial responsibility, and then you take a look and you say, oh, let me see how much I actually am worth. And you realize, like, holy crap, like they taught us all wrong growing up. And a lot of us, unfortunately, have massive amounts of debt between single family homes, cars, school. And our net worth, once we truly look at it, is super negative versus on just a dollar. Many of us don't realize we're not even a dollar positive on net worth. And that's like just ground, the first level of wealth. And it's interesting. So, yeah, very interesting story how, similar our stories are, and I'm sure many others, in this real estate world. So, let's move forward. So, today our conversation is going to be around there's many conversations that I'm sure Andrew could touch on, but we're going to touch on CapEx as our conversation of the day. Me going through my, short period of investing, if there's one thing that I advise investors on when getting into properties, one of maybe the top two or three is have money reserves, focus on CapEx because CapEx will, in my opinion, be one of the things that tear you up and get you out the game immediately if you don't plan it right. So we're going to have that conversation. I'm sure Andrew has a ton of experience when it comes to CapEx and what that means. And really, the first question we have here is, around what that means. So starting with the basics, Andrew, how do you define CapEx in the context of multifamily investing? Why is it so critical in your underwriting processes?
CapEx, more or less, is money you will spend down the road if you do not address it now at a more
Mm.
expensive rate, right?
Mm.
And when I define CapEx, I define like what are the systems that make up the building, the roof, the foundation, right? The beams, the joists, the heating systems, the electrical, the plumbing, like what's everything that encompasses within this building that puts it together, and that's CapEx, right? But all CapEx is not created equal, right?
Mm.
Some CapEx provides a better return on investment than other CapEx. And I'll just give you a quick example. A sewer line. Like, obviously, you need a sewer line to get all of the waste out of the property. You're not going to pay a premium for a new sewer line, right? But it needs to be done. So when you're doing your due diligence, it's incredibly important to get your sewer line scoped if you suspect there may be an issue, right? Because you're not going to get that money back on that CapEx expense versus shared heat, right? If everybody's on shared heat, and we're both in Massachusetts, we're both in New England, there's a ton of rebate programs that allow you to separate heat at a discounted price. That's a really great CapEx because it helps your bottom line, your net operating income, and especially in commercial real estate, anything you can do to enhance the net operating income via lowering expenses or increasing revenue increases the overall value of the property.
Nice, very good, very good. And so just jumping back on that, what are your thoughts on shared heat versus this random shared heat versus split utilities when it comes to capex? Because a lot of investors I speak to, in this context of multifamily, some of the larger buildings, especially I'm in Hartford County a lot.
Sure.
A lot of buildings have just 25 units. They'll have combined heat versus
Yeah.
split, and some owners say that's better capex long term or short term because it's one replacement versus 25. What are your thoughts?
I think that's absolutely the wrong approach, especially when it comes to commercial property, which is largely based on net operating income. And don't get me wrong, everybody has their own strategy. What my strategy is, day one, I underwrite based off what I need to put in this building to get it to 100%. And I budget for that upfront, and I combine that with, at peak stabilization, wherever this value be when the pro forma or the market rents are, right? So I essentially build up all the money up front, and I give myself a year to get to that endpoint. That's how I underwrite property, and that's how I utilize velocity of capital, keep utilizing the same money to buy more property. Because if I do that, I create equity. I can suck that out in the form of a cash out refinance, a sale, a 1031. But that's more or less my approach when it comes to CapEx. Regarding separating heat, it's the easiest thing to help the bottom line. I mean, and there's multiple ways to do it, and you could do it very creatively. Like, say for example, all of the units have a separate electric meters, and they're all one bed units. You could easily do electric baseboard on all the units at 2-3K a pop, right? And that's astronomically going to increase the value of property from an income approach, right? That's a super easy way to do that. Or in Massachusetts, there are heat pump programs where the state will give you up to $10,000 for a heat pump replacement, right? So if you know how to utilize those programs, you can get a lot of the separation of heat covered and still get that, big bump in revenue and the lower expenses, right? So, that's kind of the approach I take with separating heat. So I always budget to separate heat. There is never a situation where I do not budget to separate heat or electricity.
Very good. All right, very understood and not very good. All right, let's keep it moving here. So, a lot of investors get excited about projected cash flow, but how do you stress test the deal to make sure you're not overlooking major capex that could potentially kill your deal?
So the number one rule in real estate, the most common thing in real estate is you will go over budget. There's no ifs, ands, or buts. On every project, you will go over budget. So best practice is to allocate a 15 to 20% contingency on top of all of your renovation plans, right? That's number one. Number two is you're going to want to budget for every single line item day one. And you're going to want to figure out how you're going to fund those CapEx over time. What I do to fund my CapEx is I combine my debt with bank financing. A lot of these small portfolio lenders, credit unions, small banks offer construction money up there, cover up to 75%, even 100% of construction. I've literally got $400,000 of construction money covered at 100% from a bank simply for asking for it.
Nice. Very good. And kind of going on top of that question, how do you project what needs to be put into your capex day one versus what maybe saved for over cash flow? For example, you have say you have a 10 unit heating systems are all roughly 25 to 40 years old. You know that some are end of life. How do you determine what needs to be done first now, acquisition versus what can be done maybe in the next couple of years?
Yeah, I mean, if the heating system's working, I'm not going to proactively change it. But you're telling me if, on a 10 unit property, if all of them are, 20 years in life, I may budget for 30 to 40% of them that I would have to replace over the year period, right? But the main reason why it's very important to front load your CapEx is if you do it intelligently, you can get somebody else to cover the bill. In my particular
Mm,
case, I get banks to cover the CapEx, right? And you got to think about it. When I'm buying these
mm.
properties at a 10, 11, 12% cash on cash return, once it's stabilized, and I'm borrowing the CapEx funds at a 6.5 or 7% from a small local credit union or bank, my overall return across that deal is amplified, right? So
Ooh.
I try to address all my CapEx up front as quickly as possible while the bank will cover that, while the bank will cover those expenses.
Ooh, that's so good what you just said. I wish I could repeat it, but I'm sure the audience, will rewind that, a few times and listen to that. Is financing your repairs and capex upfront if you have the ability to do that versus waiting until 2 years down. Now you're coming out of pocket cash that you may or may not even accounted for, which is you're almost worse off if anything in that situation if you didn't budget for it. But definitely having the bank allowing the bank to kind of take on that load of some of that capex and repairs is super important. It's something I don't think a lot of investors really consider, even if it's capex that may not necessarily need to be done right now. I'd imagine if it's something like a roof, you see a roof that's 25 years and you see it's on its way, that's a good opportunity to get in. Yes, it may suck, but it's going to happen at some point, and it may be better just to front load it now than to wait 3 years and have a capital, not cap call, but capital be called for to be 20, 30, 40 grand to replace a roof.
Yeah. I
Yeah.
mean, and you got to keep in mind in our particular market, all of our multifamily are over 100 years old. These
Mm,
multifamily are converted properties in mill towns with workforce housing, right? So all these properties were constructed between 1880 and 1920, right? So what does that mean? That means that up here in the Northeast, we deal with higher capex overhead than other particular states because we have older properties, right? So when you front load the expenses and you front load repairing all those capex, you actually ensure your property will cash flow. Because you and I both
mm.
know cash flow is not the revenue minus the mortgage expense. There's there's
It's not.
there's 30 to 35% of phantom expenses taken right off the top of the revenue that go to other costs that will hit your bottom line.
Yeah, absolutely. No, very good. Well spoken. So next question kind of ties in what some of the things you already said, and a lot of it is really, bank funding. But when talking about raising money or structuring deals, when you're walking to value add and there's capex required, like how are you structuring your deals? How are you coming up with the money? How are you, how are you working the money?
Totally, totally. So I do a lot of my deals via joint ventures and or syndications if it's a larger deal. And the way I fund that particular deal is, I'll get it under contract and I get these properties under contract that with really juicy upside. So we're getting these units at a 20 to 30% discount combined with depressed rents at 30 to 40%, which allows you to really utilize the income approach to bring up the value of these particular properties. So what we normally do is we get these properties under contract, and then we typically raise 25% of the down payment plus operating expenses, which is typically 6 to 8 months of pity, combined with our portion of the construction money. Some banks will cover up to 75% of the construction money. Other banks will cover up to 100% of the construction money. And when we request the construction money from these banks, we're very conservative with our numbers and our estimations. We choose all the high numbers and we build in contingencies, right? And then, when we actually close on the prop, we front load all the expenses and we get most of our capex plan done within the first 3 or 4 months. Because when you take this money from the bank, you typically only have a year or two to utilize it, right? So it's in our best interest to get through our business plan as quickly as possible while we have access to the money.
Got it. And how heavily are the banks scrutinizing these repairs that you're proposing as part of the construction budget? Or like if you're replacing, say a roof or a heating system, and it may not be necessarily end of life day one, but maybe some next 2 or 3 years, but you want to do it in the next year. How are they scrutinizing? How are they looking at that?
So they're simply looking at it from an appraisal standpoint. So when you ask for construction money, the appraiser does two type of appraisals. They do a before appraisal. What is your property valued as of today? And then they do an after repair value. What is your property valued once the renovations are complete and you get the rents that you propose you're going to get? And that's simply what the bank uses, right? So the main thing is your after repair appraisal has to meet where you're, the debt that you're requesting. So that's typically the only barrier you run across. If you're asking if the base scrutinizes the age of the roof or these unit turns, they typically do not.
All right, so Andrew, so next question is regarding momentum of deals or velocity of deals and how much you could take on at any given time, and how do you maintain that momentum in your deal flow while managing ongoing CapEx projects?
I mean, that's a great question, and the answer is quite simple. We created a formula of buying value add multifamily. We utilize the same exact business strategy with every multifamily, and it's simply a plug and play, right? So the
Mm,
way we do it is we front load the capex. We get in there, we do everything within the first 3 to 4 months. We meet the tenants. We utilize the binder strategy to keep inherited tenants while getting the rents as close to market while we enhance the property. Once the property is enhanced, we have that conversation with the tenants again, bringing rents relatively close to market. And then at that point, we enact either a refinance or potentially a 1031. But at that point, our business plan is complete. Typically, we normally do this within 6 to 12 months. So that allows us really to keep the momentum going. And, combined with this, I also have a PM company where we manage 250 doors. But
nice.
that also has 19 people that work for it, right? So I can really utilize that resource center for other aspects of my business to keep the velocity going. Think project managers, think administrative staff to kind of implement rent increases, like think operations manager that can really, keep track of some of these contractors. So it's really about leveraging a team combined with a proven formula on how to achieve wealth.
Very good, very good. And question on your deals, what's the typical hold period of your deals? Is it pretty standard for how long you're holding, or it depends on the deal?
So we buy value add multi. We do flip a lot of 2 to 4 unit properties. So it's a different
Sure.
model when it comes to flipping properties. We do specifically focus on flipping only multifamily properties because it allows multiple exit strategies.
Mm,
But going back to your question about like what's the hold time, we're buy and hold investors. Our plan is to hold it indefinitely, and we like to
nice.
suck out equity in the form of a cash or refinance and or a 1031. We have 1031 multiple investments into other investments. We're currently working on 1031ing 2 6 units in Providence into a 60 unit in North Situate right now. I'm also 1031ing a 3 unit in Worcester to a 6 unit in Worcester at this very moment. So we recycle capital a lot to buy more property.
All right, so staying on that topic of velocity of deals
Mhm.
and acquisitions during CapEx, maybe give us an example of something that you've worked on in the past or currently working on
Totally.
that kind of plugs into that business model that you mentioned.
So I'll give you a sequence of events that puts us in perfect perspective, right? So me and my partner, we bought this 5 unit in Worcester, Massachusetts, a 5 unit for $650,000. At that point, the rents were around $3,500. The property was in fantastic shape, but the issue there was the fact that they just rents weren't there. And if
Mm,
anybody knows anything about commercial debt, like if the debt service coverage ratio doesn't equal a certain percentage, the bank won't give you a loan in a certain LTV or loan to value, right?
yeah.
So what did we do to get over this? Going back to the theme throughout the entire, presentation, it was construction money. And the amazing thing about utilizing construction money is when you utilize construction money, the bank does a current appraisal and an after repair value appraisal. But the after repair value appraisal takes into account pro forma or market rents. So they base the debt service coverage ratio off market rents. So what does that mean in practice? That means that we were able to buy the $650,000 property with a $3,500 monthly rent roll with only 20% down because we asked for a $50,000 construction line. The building was in
Mm,
great shape. We didn't even need that much money, but we did it to get over the financing hurdles, right?
oh, got it.
So that brings the whole like how to utilize construction money in creative ways, right? Going back to velocity of capital, in a matter of 6 to 8 months, we brought the revenue on that building from 3,500 to 9 grand, right? And we essentially brought the value in that property to around $1.1 million. So what did we do? We went to the bank with the first lien and we're like, hey, this property's worth so much more. You guys are great. We would love to keep the loan with you, but we want access to all this equity. Like, what can we do? And they were like, we can give you a second lien for $156,000. We're like, fantastic.
Mm,
So we took that money, which is essentially our entire down payment, and we utilized that money to buy a 9 unit value add property in West Warwick, Rhode Island with 4 gutted units, 5 rented units. We bought that for $715,000 with hard money, 10% down. The hard money lender covered 100% of the renovation. We put $200,000 into it. A year later, we refinanced that for $1.52 million, took $250,000 out, right? So with our initial capital, I think me and my partner brought 80K each. Now we essentially return our capital. Now we have 250, and we took that $250,000 to buy a 21 unit in Lowell, Mass that we closed last month. That we do utilize the same exact strategy. Value add multifamily. Then current rent rolls around 18 grand. Once we're done, the rent roll will be about 40 grand per month, and we're going to use that same sort of velocity of capital to buy more deals. So that's kind of like a deal, like in practice, utilizing all these functionalities in unison.
Sure. Ooh, very good. And just going back to the beginning of that answer or response you just gave. So with the construction loan, like you said, you bought a relatively turnkey multifamily, minus the rents being lower. How, when talking with the bank about that, what are that construction budget? How are you proposing that to them, or how are they seeing that? If the building's in good condition, you know what I'm asking? How are they looking at that? Are they just saying, yeah,
It's all about providing. It's all about finding value. And in this particular property, there were 3 units that were 2 beds that could be created into 3 beds. So we utilized that money to make those units from 2 beds to 3 beds, hence increase the overall revenue in the property. And we essentially use that. We use that money for primarily cosmetic upgrades and 2 heating units. That's what we sold the bank. That's what we used it on, and that's ultimately kind of what brought the value up so quickly.
sure. And in the end, you probably, even if you could just increase rents and not necessarily to make the repairs you initially said you were planning to, as long as you get to where your plan said it was going to be, then that's probably what matters in the end.
Yeah,
Oh,
exactly.
perfect.
Exactly. I mean, that's the magical thing about commercial property that not many people talk about is it's primarily the value of it's primarily based on the income approach, right? So it's way easier to burr. It's way easier to figure out where the end valuation would be because you have so much more control over it. Because essentially, it's just the income of the property, right? How
Yeah,
can you not
absolutely.
have control over that? Versus other asset classes like small residential is based off the sales comp approach. You could put $1 million in the property. It could be the most beautiful 3 unit on the block, but if every other 3 units selling for $70,000, that's what you're gonna get for it.
Yeah, absolutely. And kind of going back to what you mentioned about you guys flipping, probably residential multifamily 2 to 4 units. I absolutely think that's probably the move in most of the deals in this market because that space is so saturated and so hard to make any money. And if you do get something, people are going to overpay, based on emotions and them needing to live there a lot of the times and actually like making money. So
Yeah.
it's interesting you said that. Yeah. No, very good. All right, cool. So Andrew, we're going to start to wrap this up. Got a few questions left for you, but these are more on the personal side outside of the business. So when you're not operating in the business, what are some of your hobbies? What do you enjoy doing?
So I love personal development. I live for personal development. So I'm part of a mastermind, Go Abundance, where we have conferences. It's all about just learning how to grow, personally, health wise, business wise. I'm also an avid traveler. I mean, my goal this year is to travel to 12 different places. I think I'm going to
Mm.
Austin in a week. I think after that I'm going to the Caribbean. So I got a bunch of trips planned. And then yeah, I mean, just going to the gym and going hiking is probably I spend a lot of time in real estate. I'm not going to kid you.
That's all right. You love it and enjoy it, so there's nothing wrong with that. As long as it's fun to you for sure.
Yeah.
Oh, very good. All right, no, cool. How do people find you and get a hold of you?
So people can find me at Investor Freed on Instagram or Andrew Freed on Facebook or LinkedIn. And I also host one of the largest real estate meetups in Worcester, Massachusetts. I'm Simplified REI, so come check that out. We do it once a month, same time, same place.
Got it. Absolutely. How big is that meetup? I mean, I run a meetup in Connecticut as well. Like, tell me, 30 seconds. Like, how did that start? What's the size? What's the normal structure of it? Just curious.
We started that meetup, I believe, July 2021. So it's been going for a good 3 or 4 years at this point.
Nice.
We typically have 50 to 70 people attend.
Ooh.
And the format is, a guest speaker normally tells their journey, provides some value to our audience. We offer some off-market properties, give some market trends. Then it's primarily meant just for allow people to network and to know each other, which that's where the real value is, in my opinion.
Absolutely. No, and it's always appreciated, us that run meetups because the connections we create, even outside of ourselves for others, is just
Totally.
a true value add that many don't know until a few years later when they realize like that one connection you made at the meetup has changed your life. So no, I appreciate you for that. And lastly, any final words for our audience before we take off?
I would just say that, I've tried get rich quick schemes in so many different industries. I tried growing cannabis at one point. I tried stock. I tried crypto. Nothing really hit until I found real estate. So, at the end of the day, real estate is really a magic pill to escape the rat race. And I highly recommend people leaned into it because it's not only a journey of wealth building, but it's also a journey of self development. And you grow as a
Mm,
person as well as you grow in wealth.
yeah. Well said. Well said. Agreed. All right, Andrew. So very good conversation. I'm so happy that we were able to connect and you reached out and we made this happen. And all right, so we're gonna wrap up. So to our audience, thank you all so much for joining us for another episode of the Agent Investor. We want to wish you all the best in your happiness and wealth. And Andrew, thank you so much for joining us. And I hope that people are able to connect with you afterwards, join your meetup, and connect with you directly. And until then, thank you all once again. We look forward to catching you on the next episode. See you all later.